Welcome back to our channel. Today we're tackling a topic that's been on many investors' minds, timing the market. More specifically, we'll explore why you shouldn't worry about buying stocks at all-time highs, and why trying to time the market is often a futile exercise. So you've probably heard the saying, buy low, sell high. It sounds simple enough, right? Buy stocks when prices are low and sell them when prices are high to maximize your profits. But in reality, this strategy is much easier said than done. Let's dive into why that is and why you might be better off not worrying about market timing at all. Over the long term, the broad market, represented by indexes like the S&P 500, has shown a consistent upward trend. Yes, there are dips and crashes along the way. Think of the 2008 financial crisis or the dot-com bubble burst in the early 2000s. But despite these setbacks, the market has always recovered and gone on to reach new heights. If you look at the data, you'll notice something interesting. Even if you had invested at what seemed like the worst possible times during all-time highs, your investments would have grown significantly over the long term. For example, if you had invested in the S&P 500 at its peak before the 2008 crash, you would have experienced some pain in the short term. However, if you held on to your investment, you would have seen substantial gains in the following years as the market recovered and reached new highs. Many renowned investors like Warren Buffett have long advocated for a long-term investment strategy. Buffett famously said, "The stock market is designed to transfer money from the active to the patient." This means that those who try to outsmart the market by constantly buying and selling often end up worse off than those who simply buy and hold. Studies have shown that the majority of day traders and market timers fail to beat the market. In fact, a study by the University of California found that individual investors who traded frequently underperformed the market by a significant margin. Why? Because it's nearly impossible to consistently predict market movements. Even professional investors and analysts often get it wrong. So why is it so difficult to time the market? Well, the market is influenced by a multitude of factors: economic data, corporate earnings, geopolitical events, and even investor sentiment. Predicting how all these elements will interact at any given moment is incredibly challenging, if not impossible. Market timing requires not just one correct decision, but two: knowing when to get out and when to get back in. And getting either of these decisions wrong can be costly. For instance, if you sell during a downturn to avoid further losses, you might miss out on the subsequent recovery. The market often rebounds quickly, and missing just a few of the best trading days can significantly impact your returns. The market dropped sharply in March, but then rebounded quickly and continued to reach new all-time highs. Whether you are investing in index-based or active-based ETFs, it is essential to stay informed about corporate actions like stock splits and understand how they might impact your investment. Those who sold in panic missed out on one of the fastest recoveries in market history. This is a clear example of why staying invested, even during turbulent times, can be beneficial. One effective strategy is dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market's performance. By doing this, you buy more shares when prices are low, and fewer shares when prices are high, potentially lowering your average cost per share over time. This approach takes the guesswork out of investing and can help mitigate the impact of market volatility. Another important aspect is diversification. By spreading your investments across a variety of asset classes, such as stocks, bonds, and real estate, you can reduce your overall risk. Diversification helps ensure that you're not overly exposed to the poor performance of any single investment or market sector. Finally, let's talk about the benefits of a long-term investment horizon. When you invest for the long term, you allow your investments to compound. Compounding is the process where your investment earnings generate their own earnings. Over time, this can lead to exponential growth. The longer you stay invested, the more you can benefit from compounding. For example, if you invest $10,000 at an average annual return of 7%, your investment would grow to nearly $20,000 in 10 years, $40,000 in 20 years, and $80,000 in 30 years. This growth happens even if the market experiences ups and downs along the way. In summary, trying to time the market or worrying about buying at all-time highs is generally not a wise strategy. The stock market's long-term upward trajectory, the difficulty of predicting market movements, and the benefits of staying invested make a strong case for a more patient approach. Focus on building a diversified portfolio. Consider dollar-cost averaging and think long-term. By doing so, you can harness the power of the stock market to grow your wealth over time. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more investing tips and insights. Let us know in the comments if you have any questions or topics you'd like us to cover in future videos. Thanks for watching and happy investing.